In this video, I'm going to show you the one index fund that I think is best for completely passive investors. If you're someone who just wants to invest 200, 300, 500 pounds per month into a fund for the long term, then this is the one fund that I would use in 2023. This fund is a high quality, low fee, and is diversified globally. If that's what you're looking for, this is probably going to be for you. Now, I'm sure most of you already know, but before we get into the index fund itself, let me give you a 30-second rundown on what an index fund actually is. An index fund is a pre-made portfolio constructed to track a financial market index such as the S&P 500 or the FTSE 100 or plenty of other indexes out there. Index funds provide you with broad market exposure and low operating expenses. No matter the state of the market, these funds will just simply track that index. There's no active management happening in the background. Nobody's buying and selling stuff to try and hedge against the market like there is with an active fund. The fees on this are significantly cheaper than active funds, and less than 7% of US equity funds beat the market over a 10-year period anyway. If the professionals can't beat the market, we probably can't either. And that's why I prefer to invest in index funds, which give me diversified exposure to the market at a better price. But what about individual stock picking? Is index investing better? Well, most retail investors won't beat the market. And quite frankly, how many of us really want to sit behind our computers every day anyway? Do you want to sit and listen to earnings calls, read reports? Probably not. If you just simply want to invest for retirement and know that you should be investing for your future, index funds is probably the best way to go about it. Investing in index funds is not going to get you those 1000% gains in a year, but you also probably won't have an 80% drop in a single month. For most people, accepting a 7 to 8% market return until they retire is an amazing strategy. That may not seem like much, but investing £300 per month from 25 to 65 at an average of 8% return leaves you with a portfolio of £1,047,302. And to get there, you only had to contribute £144,000. Compound interest did the rest of the legwork. So now that you understand the benefits of an index fund, let's take a look at what I'm looking for in them. Your goals may be slightly different than mine, but let me explain mine so you can understand where I'm coming from when I picked this specific fund. I want global diversification with a heavy weighting towards the United States. Some people, they'll only invest in the UK, others will only invest in the United States, but I want diversification across the globe with a heavy weighting towards the US. Most of the growth in the past decade has come out of the United States, especially in the tech sector. Now, I'm big into tech, and I believe that that is going to continue, especially with AI and the massive leaps it's making right now. If you look at the FTSE 100, it has virtually no exposure to tech, and that's why over the past 10 years, it has significantly underperformed the S&P 500. I also want some exposure to Europe and other developed markets. As the saying goes, don't put all your eggs in one basket. Certain periods will see some economies perform better than others. Having exposure to them helps to limit the volatility in your portfolio slightly. Next up, I want low fees. Most index funds are fairly low fees, coming in at 0.06% roughly to about 0.3%, depending on the type of index fund you're investing in. The lower the fees, the better. Last but not least, I want a long track record of success offered by a quality company. Now, let's take a look at the fund itself. The one index fund I would use for a one fund portfolio is the Fidelity Index World Fund. Now, let's break down some of the specifics of this fund. First off, it's obviously managed by Fidelity. They've been in business for over 70 years, which ticks that requirement of mine that the company has to have a long track record of success. And the fund itself was constructed back in 2014, so it's been around for almost 9 or 10 years nearly to give us a good track record to look at. In terms of fees, it costs 0.12% annually, which isn't the cheapest of all index funds out there, but compared to others that offer global diversification, it's one of the best options. In the United States, you'll actually find some funds with expense ratios as low as 0.03%, but unfortunately, we don't get rates as low as that in the UK. Unlike ETFs, which can have liquidity problems when it comes to selling them, index funds can be redeemed with the fund provider at any time. So even though liquidity isn't a problem, this fund has over 5.6 billion currently under management as I'm making this video. It's a popular fund to say the least. The fund itself tracks the MSCI World Net Return Index and has 1,510 individual holdings. So now that we know the basics, let's take a look at where the portfolio is invested as well as some of the top holdings in this portfolio. The portfolio consists of 97.76% stock and 0.04% bonds and about 2% cash or so at the time I'm making this video. Most brokers or robo-advisors would classify this as a risky or aggressive investing strategy. However, over the long term, equities significantly outperform other asset classes. If I was 5 to 10 years away from retirement, I would consider rebalancing this portfolio a little bit to make it more conservative. The closer you are to retirement, the less time you have to recover from those large losses. So I'm currently 26 and can deal with the market dropping right now in the short term if it outperforms significantly over the long term. However, if you're someone who is retiring soon, you may want more allocation towards bonds. In terms of geographical regions, almost 69% is invested in the United States, 9% in the Eurozone, 6% in Japan, 5% in Europe excluding Euro, 4% in the UK, and some in Canada, Australasia, and developed Asia. I'm happy with the weighting towards America, and if you look at past returns of the UK FTSE 100 versus the S&P 500, the US significantly outperforms the UK. In the past couple of decades, a large reason for that, as I mentioned, is that growth in big tech. The FTSE 100 basically contains no technology companies. Major big tech players operate and list on United States stock exchanges. Personally, I believe tech will continue to perform well over the next decade as AI rapidly evolves. And I don't know which specific companies will benefit from this, but I do bet that in 10 years they're sitting in the S&P 500. Having a large portion of my portfolio aimed at the United States gives me that exposure to this, as well as many other markets for diversification. You also benefit from the 30% or so exposure elsewhere in the world, mainly Europe and the UK with a slight portion of Asia. Over time, different countries will perform well in different periods. While one is doing well, the others may do poorly and vice versa. Because of this, you tend to get less volatile growth with a global index fund such as this one compared to the S&P 500 by itself. Before we take a look at the performance of the Fidelity World Index versus the S&P and FTSE 100, let's take a look at the sectors it invests in and the top holdings of the actual index. In terms of sectors, you can see the breakdown on the screen right now. We have 3.9% in basic materials, 10.7% in consumer cyclical, 14.5% in financial services, 2.3% in real estate, 7.34% in comm services, 5.32% in energy, 10.6% industrials, 22 or so in technology, 7.13% in consumer defensive, 13 or so in healthcare, and 2.54 in utilities. The portfolio is fairly well diversified across multiple different sectors. The top holdings in this portfolio essentially mimic the top 10 holdings in the S&P 500. We have all the big names you'd expect to see there: Apple, Microsoft, Amazon, Nvidia, Alphabet and Tesla, Meta, Exxon, and United Health Group. These top 10 holdings make up roughly 19.59% of the portfolio. So as you can see, the top 10 holdings are also tech heavy, as those are some of the largest companies in the index. 10 companies out of the 1,510 make up 20% of the holdings. So if we did see a huge dip in tech valuations, it's still going to pull this portfolio down fairly heavily. Past performance obviously doesn't indicate future results, but I do think it's worthwhile to take a look at the historical performance of this portfolio versus the S&P 500 and the FTSE 100. So here we can see the Fidelity Index World Fund versus the S&P 500 versus the FTSE 100. And it's clear to see here on this graph that the S&P 500 has outperformed each of them. And this graph is from 2015 to 2023, the past 8 years. Now, obviously, in the past 8 years, tech has been massive. And that's why you're seeing here the S&P 500 just outperform each of these. Obviously, the FTSE 100, very low percentage in tech, pretty much nothing at all. The Fidelity Index World, it has all of those tech companies in there, and it's a huge portion of it, but you do also have that 30% of the developed market. Now, over the past decade, the developed markets in Europe, etc., haven't performed as well as maybe in the past they did. So that's why you're seeing here in this period, you know, the Fidelity Index World isn't doing as great as the S&P 500. But I want to be diversified across multiple regions so that whenever these markets do perhaps perform well, while, you know, maybe the American market just isn't performing as good in the next 10, 20 years, we're getting those gains. And that will help limit some of the volatility that you would get in the portfolio if you solely invested in the S&P 500. Now, it's completely up to you. You might decide that the S&P 500 is for you, but for me, I would rather that diversification. Now, you can also see here the FTSE 100 is getting completely decimated by both of these portfolios. It just hasn't performed anywhere near to where they have. And all of these funds are accumulation funds, which means they're reinvesting the dividends. You can get distribution versions of each of them. So that's how it's performed over the past 8 years or so, and kind of my reasoning behind going for the Fidelity Index World and having that slightly more diversification globally versus just investing in something like the S&P 500. So while it hasn't outperformed the S&P 500 in the past 8 years, it makes for steadier growth over time with fewer peaks and dips. And that right there is my main reasons for investing in the Fidelity World Index Fund. If you want to invest in this fund, you can find it on most popular brokerages out there. As it is an index fund, sometimes it's not available on some of the apps that you may use, such as Trading 212, etc., but you will be able to find it on most traditional legacy brokerages. Personally, I use Hargreaves Lansdowne to purchase my shares in this index fund. So if you want to, you can use our link in the description down below. It helps us out and we get a small commission. As always, capital is at risk when investing. If you do want to see more from this channel, make sure to subscribe and stick around for many more videos just like this. If you do want over 100 free guides on personal finance and investing, check out moneysprout.co.uk. There's a ton of stuff over there. We're a new site, but we're up and coming and we've put out some great content already. I'll see you guys in the next one.